I had a reader post a comment on nextbigtrade.com concerning using the stage analysis screener to trade indexes, and in particular she was interested in trading the TSX. So in this video I want to discuss using the stage analysis screener to determine things like trend, breadth, leadership sectors, and leading individual stocks in an index. And looking at these different items will help you determine kind of the overall strength and or weakness in an index, and see where it may be headed next. Now, just a quick recap on stage analysis. The point of stage analysis is to get in early in bull markets, which are stage 2 advances in stage analysis, and get out of bear markets, which are also called stage 4 declines. And really it's just a trend following method. So it's obviously you're just detecting a new breakout into a stage 2 advance and then getting out of a stage 4 bear market early enough to avoid major losses in a bear market. Now you can see this shows the last 10-year history of the TSX, and obviously using a trend following system like stage analysis would have kept you out of the devastating bear market, or a large portion of it, in 2008, which actually this index is still 10 years later almost to the top of the range, but you can see how devastating a bear market can be, even to an index. And the TSX has had one other notable stage 4 decline really in the last 10 years during the 2014 to 2015 kind of mini bear market, where a lot of commodity sectors were hit hard, especially the oil and gas sector. Now, this leads you into understanding the makeup of your index can help you out to determine, whether it's going to be in a sustainable bull market or not. And the TSX is very heavily influenced by commodity sectors. So when this kind of collapse in the price of oil happened in 2014, it really had a negative impact on the TSX. And one thing you could do to kind of help trade the TSX would be to look at a sector like oil and gas and observe that whenever oil and gas is in a stage 4 decline, it's going to have a big impact on the TSX. So you could see things like oil and gas, whenever it rolls over before the TSX, I would think you would want to pay careful attention to that, because that could have a big impact on that index. Now, as far as trading the TSX and understanding what stage it's in, probably one of the best ETFs to use would be the EWC ETF. I'm not sure if there's a ETF on the Toronto Stock Exchange that tracks the TSX specifically, but the EWC is one of the biggest country ETFs, and it is a little bit more heavily weighted towards financials, which is why it's actually still in stage 2 here, where the TSX is starting to roll over a little bit below the moving average. But as far as tracking the Toronto stock market, EWC might be one of the best options. And you can see again, after the carnage in 2008, this ETF is still not to the top of the range yet. And it did have a very sizable decline starting in 2014, even though this ETF is more weighted towards financials. So the impact on the oil and gas markets hit this ETF pretty hard. But let's go over to the stage analysis screener, and if we just type in EWC at the top, we can see that it's still in stage 2, but it's not too far away from the moving average, so it's just kind of trending above it at a very moderate pace. One thing to note about the world major foreign markets is that they're all in stage 2, and this is another important thing to pay attention to, because when the stock markets around the world are in unison going up in stage 2, a lot of times they can drag along the weakest markets with them when the world markets are in a strong bull market. So if you sort by percent above the moving average, you can see that Canada is actually basically the weakest established foreign market in this list, which is interesting because it's trailing a lot of other established markets, including the U.S. and a lot of Asian markets. And then turning to breadth, which I had on my list, you can note that if you sort by stage 2, the TSX is actually at the bottom of all these different baskets of stocks. And one thing I like to look at when I go to the indexes page is the percentage of stocks in stage 2 and stage 1 versus stage 3 and stage 4. So look at how about 60% of stocks in the TSX are in stage 3 and stage 4. So 60% are either topping out or in a downtrend, versus only about 40% are either basing or in a stage 2 advance. And this tells you that the skew of the percentage of stocks in the index is weighted towards a bearish slant, which is why the TSX is having so much trouble moving higher, is there's just a lot of stocks weighing down this index. And the same thing goes for the TSX Venture, which has a lot more smaller cap and risky companies. There's even a bigger bearish percentage of stocks in that index versus the TSX. And you would expect a strong bull market in Canada would have these things potentially reversed, where there'd be even more speculative money in the smaller cap stocks versus the larger cap stocks in the TSX. Now, you can see the kind of the same thing with the U.S. markets, and even though we've had a strong bull market so far in 2017 in the U.S., a lot of it's been led by large cap stocks in the U.S., which is why you see things like the Dow Jones and the S&P 500 having a stronger breadth than the NASDAQ. That's because a lot of these larger cap technology stocks are leading the market higher this year in the U.S. And then, as I said, the Canadian indexes are heavily influenced by commodities. So if you look at the GCC ETF, which is one of the best ETFs to look at to understand the trend in commodities, you can see that GCC is still in stage 4. And if I look at the chart of GCC, again, it's been in a long-term bear market for a while now, and it's been basing out for the last year and a half, but it still hasn't broken out again back above the moving average as it did in 2016 for a little while. And that's why we saw that strength in the TSX for a while in 2016. Now, looking at the Canadian banks, which is probably the other big sector in the Canadian markets besides the oil and gas and commodities related sectors, you can see that some of these big Canadian banks are kind of struggling with the 30-week moving average. And I've tweeted about the Canadian housing bubble finally bursting, and it's going to be interesting to see whether a potential collapse in the real estate market in Canada, how it has an effect on the banks in Canada. We saw how devastating it was for the U.S. banks, the real estate collapse in the U.S., but those banks were also highly leveraged, and there's a lot of discussion that the Canadian banks may not be quite as leveraged. They might have learned somewhat of a lesson, but you never know. I would always trust the charts over what anyone's opinion is, but needless to say, these banks are at an interesting juncture because they've been in an advance for a while, but they're kind of struggling with the moving average right now. So it's definitely something to keep an eye on. Here's another Canadian bank, Toronto Dominion Bank, where it's kind of like maybe potentially setting up a stage 3 top, but it's still kind of holding above the moving average for now. So turning back to what we said at the beginning, obviously trend is the most important thing to understand when you're trading indexes. So whether an index is in stage 2, stage 3, or stage 4 should help you develop a trading system for the index. And then looking at breadth obviously will help you determine how strong the index is, and any big shifts in breadth would help you potentially determine whether there's going to be a big shift in the strength of the index. A lot of times you'll see a basket of stocks or a sector start to break out higher, and that'll help you probably help the index power higher. I would definitely keep an eye on oil and gas related stocks for the TSX. And what you want to do as far as individual stocks really is, even if you look at the number of individual stocks that are showing up on the watch list, if you just filter down to TSX stocks, and I've been observing this for basically this entire year, but the number of stocks popping up on the watch list has been very low for the TSX this entire year, and this is another sign that this index is just overall very weak, because when an index is strong, you'll see a lot of stocks breaking out to the upside, and really the leading stocks are what push the market higher. So this is another sign that this is not the case for the TSX, because there's a low amount of stocks that are breaking out on big volume. And what you really what you want to do is, you start to track these stocks, and what you can do is just follow them using the stage analysis screener. And then if you go to the follow page, they'll show up over here. And what I like to do is basically keep a list of stocks that I'm either currently trading or that I'm interested in, and see how they act. I trade a lot of individual stocks more than sectors and indexes, but keeping track of what stocks are doing, what ETFs are doing, baskets of ETFs for sectors, will help you determine the strength of the index overall. And if you see a shift in volume all of a sudden, and a shift in the amount of stocks that are moving into stage 2, that will help signal to you that the index is getting ready to break out to the upside. So these are all different things you can do to kind of keep track of the index. Overall, you'll definitely want to use the stage of the index as your primary signal, but using things like breadth and leading sectors and individual stocks will help you determine what the state of the index really is. And if you want to trade individual stocks, you'll want to see multiple stocks breaking out on big volume. And whenever you can get into a leading sector where a bunch of stocks are breaking out at the same time, that's the best situation to be in, because it increases your odds for success, and it allows you to find really the big winning stocks in the market, because big winning stocks are usually found in big winning sectors.